Analyze potential tax implications for each exit strategy. Outright sale. Calculate capital gains, tax and depreciation. Recapture liability to understand total tax owed. Consider the impact on net proceeds and future reinvestment. 1031 exchange. Assess how deferring taxes with a 1031 exchange enhances purchasing power and evaluate suitable replacement properties to meet IRS requirements. Installment sale. If selling to a buyer willing to pay over time, estimate the capital gains tax for each installment to spread tax liability across years. Partnership buyout or property conversion. Explore tax implications of a buyout or conversion, for example, converting to condos for individual unit sales, to minimize gains while adjusting the exit. Estimate after-tax returns. Deduct capital gains and depreciation, recapture from gross sale proceeds to estimate net returns. Estimate after-tax returns. Deduct capital gains and depreciation, recapture from gross sale proceeds to estimate net returns. This comparison allows for an informed decision on which strategy optimizes after-tax returns. Refinancing impact. For refinancing, calculate interest and costs associated with refinancing, comparing these with the tax benefits of retaining ownership. Engage a tax advisor. Collaborate with a CPA or tax attorney specializing in real estate to analyze complex tax situations and determine the most tax-efficient strategy. Engage a tax advisor. Collaborate with a CPA or tax attorney specializing in real estate to analyze complex tax situations and determine the most tax-efficient strategy. Plan for potential tax changes. Work with tax advisors to stay informed on tax law changes that may impact real estate transactions, such as potential increases in capital gains tax rates or adjustments to depreciation rules. Portfolio expansion with 1031 exchanges. For those planning continued growth, use 1031 exchanges to defer taxes indefinitely, leveraging accumulated gains to acquire higher value properties. For those planning continued growth, you can use 1031 exchanges to defer taxes indefinitely. This strategy allows you to leverage accumulated gains to acquire higher value properties. Estate and inheritance planning is crucial. By holding appreciated properties and passing them to heirs, you can plan for generational wealth transfer. Heirs may receive a step-up in basis, potentially eliminating capital gains tax. Let's look at an example comparing the tax implications of selling outright versus using a 1031 exchange. Example. Comparing tax implications of selling outright versus a 1031 exchange. Imagine an investor selling a property with a $200,000 gain and $50,000 in depreciation recapture. Here's how they might compare selling outright to a 1031 exchange. Selling outright capital gains tax, $200,000 times 20% equals $40,000. Depreciation, recapture tax, $50,000 times 25% equals $12,500. Total tax liability, $52,500. Net proceeds after tax sale price minus $52,500. Using a 1031 exchange, deferred tax liability $0 immediately, preserving the entire gain for reinvestment. Net proceeds for reinvestment full sale amount, maximizing purchasing power. By using a 1031 exchange, the investor can defer $52,500 in taxes and reinvest the entire proceeds, preserving capital for future growth. Understanding tax considerations is essential for apartment investors aiming to minimize tax liabilities and maximize after-tax returns. Understanding tax considerations is essential for apartment investors aiming to minimize tax liabilities and maximize after-tax returns. By analyzing options like capital gains deferral, depreciation recapture, and 1031 exchanges, investors can develop tax-efficient exit strategies. Consulting with tax professionals and implementing proactive tax planning strategies allows small apartment investors to optimize returns and enhance financial outcomes, whether they choose to sell, refinance, or pursue a tax-deferred exit.